Welcome back to Radically Rational Radio. In this episode, Janet Yellen says the banking system is healthy despite their woes. She's telling half-truths. If you believe that interest rates are going to keep increasing, or even stay the same over a long period of time, what's happening in the regional banking industry will cascade into the big banking industry. Let's jump into it.
2 months, almost to the date, we've had 4 U.S. lenders fail. But the administration continuously says that the banking sector is sound and resilient. Is that a fair assessment when you look at the regional banking sector?
Well, the regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics that have made them vulnerable. The banks that failed tended to have substantial losses, mark-to-market losses on their hold-to-maturity portfolio. So although their regulatory capital wasn't impaired, their tangible equity was diminished. And they simultaneously had a very high proportion of uninsured deposits. And that profile is not very common. But look, a lot of banks, particularly regional banks, are seeing their earnings come under pressure. The amount that they're having to pay for deposits is rising, and in many cases their investments are at lower interest, and their stock prices are coming under pressure. But most banks now, even including the ones that are seeing pressure on their stock prices, have solid liquidity, would be able to manage paying off uninsured depositors if they were to flee.
Are you confident no other regional or small lenders will fail?
What I see is a banking system that overall is well capitalized, still has very solid earnings, and we've improved the available liquidity to the banking system, and think that banks are going to be able to survive this. But, we're monitoring the situation very, very carefully.
How can Yellen say that they're well capitalized? Mark-to-market bonds are the reason for this crash, and every bank, small, medium, and large, has U.S. bonds. They have been considered the safest way to hold liquidity. And in regards to cash flows, anyone on the right track who has a good credit score or has put a down payment on their house is about to have an increase in payments. Some of them are not going to pay. Cash flows are going to drop. And we're about to see a bunch of new loans for low-income people, which is probably going to hide these upcoming foreclosures. We know this bank failure is going to continue because so far, every fix that has been created by the FDIC and the Fed has only increased the cost of doing business for either the bank or the person. How many of the recent tech layoffs are going to have increased payments even though they no longer have a job? Unemployment will end for them soon, and they'll no longer be able to pay for that mortgage. If you think the regional banking failure was the fire, I assure you, it was only the spark. I hope you learned something. I'm Tristan. This is Radically Rational Radio. Like, comment, and subscribe. I'll see you in the next episode. Stay resilient.